So we'll start with a simple enough question. If you could all please introduce yourselves, but with focus on who you are and what your VC does. What's your investment scope when it comes to the stage and the industry you invest in, how much you invest in startups, and what makes you different than other funds, because that's always fun. So let's start maybe from this side right now. Maciej. Yeah, the mics should all work, but
I think, does it work? I think it works. Cool. Hello, everyone. I'm Maciej, one of the partners at Credo Ventures, a venture capital firm based in Prague. I'm actually based in Krakow, so I live in Krakow, quite nearby, actually.
You will have a line tomorrow.
Yeah.
Waiting for you.
Stare Podgórze district. So we are deploying a 75 million euro fund. It's our fourth fund. We invest all across Central and Eastern Europe. I'm responsible for, Poland, Polish founders, Polish companies, fintech all across CEE, and just recently, obviously AI. So we invest as early as it gets, 100K checks up to 3-4 million checks across pre-seed to seed rounds. We tend to lead the investments, so we like to have, at least 50% of the round that we would take. And we are generalistic investors, so we would invest in B2B software, consumer marketplaces, more technical things, as well as pure execution plays. So pretty much all over the place. And we like to think that our track record is pretty solid here in the region. And that's pretty much it.
So
Thanks.
that's your special thing. You have a good track record. That's good. That's great. Right, Konrad.
I mean, Credo does have a good track record. Nobody can take it away from them. So I wouldn't call it bragging. It's just facts.
You can compete. It's okay.
We will definitely. So hi, my name is Konrad. I work with SMOK Ventures, which is a fund, Polish-American fund based mostly in Warsaw. However, recently we are pretty much remote. With two people in Warsaw, one in Krakow, one in Ukraine, who's actually focused on looking for great Ukrainian startups, and two more people all over the globe. We invest in early stages, so pre-seed and seed. We invest around 300 to 500K usually per startup. Then we follow on options, of course. And we are pretty generalistic when it comes to industries. So we would do anything from B2B SaaS as far as to gaming and game dev. The 20% of our first fund was into game dev. And we're into our second fund, which has recently started investing, and that was in November. So last month we've finally finished all the paperwork and we've started investing. A few term sheets already signed, and we're happy to continue investing in Poland and Central Eastern Europe.
Cool, great. So you can attack Konrad afterwards.
Gabi.
So I'm Gabriela from Hubraum. The funny story is that I started my story in Hubraum together with Konrad, and we worked together at the beginning. Hubraum has a fund, as you probably already know, through the video showed at the beginning. We are investing in early stage startups as well on the seed stage, on pre-seed stage, sometimes on Series A. Our ticket size is up to 300K in the first round, and we have, of course, possibility of doing follow-on investment up to 1 million euro. When it comes to the geographical region, so something what makes us special, it's not being really focused on any specific region. We of course look really closely on Europe, but we do investment also in US. Also we have investment in Australia and Korea. So we are pretty open when it comes to geographical industries. And when it comes to the sectors, sectors which we are looking at. We are also pretty open. However, we have three main focus areas, which are connected, life and work, the next, and also future of connectivity. And in our portfolio, we have startups developing various technologies like AI, blockchain, IoT, edge computing. So we have like pretty broad scope of operations. Yeah, I think that it's mostly in the nutshell.
Great, thank you.
Good evening. My name is Michael. I work for Müller Media. I've been with Müller for about 20 years now. And we invest in early stage startups, mainly pre-seed, seed, and Series A around that. We focus on Central and Eastern Europe as well as Germany, and we've been very impressed with Polish startups for quite a long time. So one of our first investments in Poland was Puxi. I guess some of you know them. We are we are also an investor in Informatica, and we are here in Krakow invested in eDrone and Enso.org. Enso is a Y Combinator alum. We've also been an investor in Spacelift, and we are investor in a small a crypto startup from Warsaw called DoxyChain. We have other investments in the region, but most of them are from Poland. We also invest, of course, in German startups, as this is our home base. And what we are kind of different is that we invest only our own money. So it's practically an evergreen fund. We like opportunities, but we focus mainly on B2B, SaaS, and marketplaces. So we very rarely do something else. One exception is a craft beer a brewery in Berlin. So something totally different. But we like the product, I have to say. You can now think of something you can impress us with if you're not building software. But in general, we are really into B2B. We have a huge operative business in Germany, going back to Yellow Pages. So we are selling mainly to SMEs in Germany, and we have over 200,000 SMEs as customers. And that's also why we are investing in B2B software and B2B marketplaces, because these are products these customers can use and need to digitize their services and compete. And that is what we are looking for in a nutshell. Thank you very much, and I'm looking for your questions.
Great, thank you. Just a short question. For how long have you been testing the beer product before you invested in it?
Much longer than you can imagine. They have a large variety. I can give you the number. It's very impressive.
Thank you, thank you.
Yeah, my name is Max. I'm one of the founding partners of Sunfish Partners. We are a German-Polish fund, so we're kind of the money is German, the team is German, but we invest in Polish tech companies. Our focus is deep tech, so that's it's a very fashionable word, but for us it means tech-driven innovation. So we only do B2B. We don't do any consumer investments, and in general, our focus is on finding and identifying at pre-seed and seed stage outstanding technology companies, helping them develop their company, helping them to bring on board international investors, and helping them to grow their business internationally. So our early investments where we were already kind of able to prove this this thesis was Molecule One, for example. It's Ether Biomedical or SolveMed. These are all companies that are working in this space, often using applied machine learning, so artificial intelligence technologies in the medical field, but we're also working with other companies in the field like document processing. So yeah, we're looking at, we normally try to be first institutional investor in. We invest tickets, initial tickets between 250 and 500,000 euros. We can do a total of about 1 million euro. Yeah, so that's us. We're based in Warsaw and Berlin. Marcus will hopefully come later again, so you have two of us. You can ask questions. Yeah, that's us.
Cool, thank you.
Thank you.
Hi everyone, I'm Sebastian and I'm an investor at Innovation Nest, a fund based here in Krakow, and we are a seed and pre-seed investor investing across Europe in B2B software companies. The current fund that we have right now just finished the investment period, and we were mainly focusing on seed deals. And we are raising Fund 3, which is gonna change slightly the strategy, and we're gonna focus purely on pre-seed deals, still just in B2B software and all across Europe, investing up to €1 million per company.
Oh, that's great. What makes you special?
I think there are not that many pre-seed investors that are purely focusing on B2B software and are investing in whole Europe.
That's true. We're startuppers ourselves, and we know that there aren't many pre-seed investors out there.
Oh yeah, we need to figure it out by ourselves.
But all right, so let's talk a little bit about the landscape. In its letter to founders in May, Y Combinator urges the startups to question what you believe is the normal fundraising environment. And it asks them to prepare for a scenario in which they may not be able to raise a round for even up to 24 months. So all the startups that already have raised the rounds are supposed to, cut the cost, change their strategy, fire people, and prepare for the worst. But at the same time, they say that economic downturns often become huge opportunities for the founders who quickly change their mindset, plan ahead, and make sure the company survives. So, Dima, do you want to take over and ask some questions about this?
Oh, yeah. I will be happy because basically, it's a pretty actual question. The first one will be at the moment as how the fundraising landscape changed over the past year, and within the current economic situation, how the founders should act. And especially what we're interested in is, do you look differently at the startup now that you did it previously? Do you invest in different startups or somehow change your investment strategy to adjust it to economic situation? Do you invest less in startups in less startups? So you're trying to pick up, lesser startups, but with some other criterias. And for finishes, is it harder for startups to raise at the moment, and what you can suggest to founders basically to help them out? Let's start with who is the brave enough to start.
Oh, a lot of questions. So it has changed. Yeah. So I would say that the fundraising situation sucks right now. I mean, all across the board.
Thanks for honesty.
I believe that the main driver of the situation is just the uncertainty. Uncertainty.
No, it's okay.
Is it a word? Yeah. Honestly, no one really knows how 2023 will look like. And by saying this, I mean it. Nobody knows. I mean, we are talking with other investors, both pre-seed seed investors and Series A, Series B investors. We have some portfolio companies actively raising Series A. We have portfolio companies raising Series B as well. And definitely, one thing that started from the public markets is, and we actually have publicly listed companies as well. So, we were investors in UiPath, that is currently, a publicly listed company on NASDAQ. And when we floated the company, it was valued at $36 billion. During the IPO on the IPO day. Right now, it's $6 billion, right? So, it's quite a cut.
Tell me your exit was on the 36.
It was we still hold some equity, so unfortunately, but yeah, it was that's the reality. I mean, the company has grown throughout the last year, and the valuation still has dropped, 6 times, right? So so that is one thing. There is a huge wave of huge private companies like Klarna, like Checkout.com, that have preemptively slashed their valuations as well. Obviously, for tax reasons, for hiring reasons. So, there are different reasons, like just to show some upside on ESOP and, to make the hiring a bit easier. So there is a number of reasons why you would do that, but generally speaking, that's the wave that has started from public markets, and then obviously everyone has to see some upside, right? So growth stage investors have to see some upside, so they kind of squeeze their valuations that they can pay for Series C and D companies. And in fact, there was this pretty good report published by Cooley, which is one of the leading US-based legal firms. And they basically serve and they advise companies across the stages from seed to even basically public offerings. And Series D valuations, for example, have dropped from pre-money valuations in the first 5 months of the year. The median Series D pre-money valuation was $3.5 billion. Right now it's 575 million. So again, like 7x drop, right?
We're a little bit too far from Series D, but still.
But that actually goes across the board, right? Because like everyone has to make some money, right? So then Series C investors are investing at lower valuations. Series B investors are squeezed as well, and that actually comes to pre-seed and seed as well. So
basically, if you can say a few words like for pre-seed seed founders about like, not so motivational maybe as previously, but what because definitely if you run startup at the moment, you cannot close it because of the economic, situation and everything. What would you advise like, for those founders? I
guess you just have to be a bit more creative and more scrappy with the resources you have. And I would agree with Y Combinator actually, like, question everything and question your fundraising strategy. Don't assume the valuation, I would say, because we even in our portfolio we had founders who were pretty fixed on valuation and they didn't want to accept higher dilution. And the reality is that, in 2020 and 2019, it was the founder's market, and founder would, start a beauty contest and, say what's the dilution they want to accept. Right now, it's not the case anymore. So, yeah, I would say be more creative, prolong the runway as much as possible, and brace for the next year.
Thank you. Thanks. That was a great insights. We will speak about the numbers a little bit later, also about the traction and so on and so forth. And Konrad, what do you think about all of those questions?
I think I absolutely agree with what Maciej said, and I don't want to repeat everything that he has said. To keep it short, it is going to be a challenging year for startups and for raising money. And I think for all the people that are not into startups or not into VC that much that are here, I think it's important to understand two facts. One is that funds work in cycles, meaning that when you start a fund, it's a targeted entity that is supposed to last for 8 to 12 years. And within those 8 to 12 years, the fund will experience different economic times. And this period is actually cut in half. So you have 3 to 5 years of investment period when the fund is investing money actively into new companies, and then 3 to 5 years of the investment period where the fund holds their investment, waits until the valuation grows, and then exits. And this is important. Why? Because at the moment we have funds in different stages. So when you're asking what's the situation and are you guys investing, it really depends on where people are. And funds have realized that it's going to be difficult for them to raise new funds and that's fact number 2, that funds do not find money on the street or in the bank. They raise money as much as startups before this period of 10 years.
That might actually be a surprising fact for most of you that we are in the same business of raising money to be able to deploy it.
Absolutely. I mean, in case of Poland, 80% of funds are funded by PFR, so it's a pretty stable source of money, and we know there's a new wave of money coming in, so don't worry that much. The Polish funds will keep on investing, but there's still the part of funds which are private, and still the PFR funds need to raise a bit of private money. So now that all these existing funds realize that it's going to be difficult for them to raise private money because private investors who have a lot of cash may not want to go into the riskiest of businesses, that is VC, they started kind of investing slower to extend their period of 3 to 5 years. Because they know that in a couple of months they will, if they invest too much too quickly, then they will need to raise a new fund in difficult, challenging times.
Does that influence your investing strategy? I mean, if you can compare the startups that you were considering a year before, 2 years before, and now, what have changed? What are you mostly looking at, profitability or some traction?
We invest in pre-seed, so we cannot look at profitability, but it did influence partially the sectors that we invest in, because we try to avoid sectors which we think are the most prone to crisis, like Horeca, for example.
Okay, cool. That's a great insight. Thank you so much, Konrad. Gabriela, if you can say a few words about...
Yeah. So I think that the key word here is uncertainty, as Maciej already said. And we see, of course, the big drop downs and falls in the size of rounds, in the valuation, in the total amount of funding. In worldwide, but we also see it purely in Europe. It's dropping quarter by quarter, looking on the key statistics. So, of course, I could agree that funds are now a bit more selective, and we are trying to kind of manage the risk that we are taking. So from one hand, of course, we are trying to avoid really risky areas, but of course, as this letter of Y Combinator said, there is also a big opportunity for new sectors, for new industries, which now started to be really important and could be really profitable in some time horizon. But I don't want to be also really, really pessimistic. So I would say that we have to be aware that the funds have to work, and there is a lot of capital still on the market. Of course, this investment would be more careful, a bit more careful and a bit more selective, but for sure they will not totally stop. They would still happen. So I think that it's also something what it's important to note. And the good advice, the good tip would be to target your product and your solution to the funds that already invest in the area which you are operating in, and be really prepared, know the market which you are operating in, and try to do your best to attract those players which are active on the specific market you are operating in.
Cool. There were great insights. Thank you. Thank you so much. What do you think, Michael, about all of it?
I'm pretty much with Gabriela.
If you could please a little bit.
If you look at the number of funds and the volumes the funds raised, I think there's more capital out there, at least if you look at the last 24 months, than ever before. And this money has to be deployed, whether it's 2 years, 4 years, the time frame. But the funds simply cannot sit on that capital because the way the fund industry works, they collect a management fee, and if the capital is not deployed, they will not earn the money, and also they have to show success for the next fund. So if they do not invest, then they will have a problem with their own business. So I think also from the situation that you have some people sitting here representing funds, you can also see that the funds are still looking for new investments, and they want to find the best startups, as has been the case. Of course, the funds are more selective. I think nobody can tell you otherwise, and the valuations have gone down. That's also, I think, out of question. But that's a simple market mechanic, as we have already heard. We have to make money as well. So if the potential outcome is lower, we have to buy lower. It's also very easy. But for you as founders, I think the question is a much different one at the moment. I think if you are working on moonshot project, it will be a lot harder. If you are working on applications that really have a commercial value and you can show business units that make a lot of sense, so that we can see that with each customer you add, you will make a profit in a given period, and you all know probably the SaaS multiples and so on. There are a lot of references for the KPIs the players want to see. But if you focus on those business units and you do a good job, and I think this is something you can do, because that's what your startup will be about, then you will also be able to raise money. And we did our best investments in the times that were not so good. So we did the best investments in 2007, 2002, 2003. These were our best startups in all of our history. So I think it's also true that if you look at the very good startups, it doesn't depend on the climate, so to say. If you have a good product with good unit economics, then and the market wants your product, then you will be successful. And I think you have to focus on this one.
Cool. That sounds great. Thank you.
So now I have to try to add something new after a lot of things have been said already.
Next time we start.
Yeah. I was just wanted to propose it because otherwise it will be harder. So maybe to elaborate on a few things my fellow panelists have already said. I think one thing is uncertainty. I think what needs to happen is the uncertainty has to go away, or there has to be less uncertainty. It doesn't mean that any kind of economic crisis that we might, or recession that we might encounter, has to be over. But once we know which way it goes, right, I think this will unlock capital. It will unlock capital for fund managers, but also for the startups. Currently, it really is a period, and we saw it last summer, where people just didn't know which way it went. Was it going sideways? Was it going down? Was it recovering already? So this uncertainty is, for anyone managing money, really produces a lot of a lot of risks, and keeps them just for like making any decision, right? So that's bad. So uncertainty has to go away, even if it means that we realize that we're getting in a deep recession, because as Michael said, we have to deploy the money, right? So if we know it's a recession, I think we know more the environmental parameters and under which we will invest. So that's number one. Number two, risk. I think it was also mentioned before. I think people look much more on the risk side, on the risk and return equation, right? So riskier projects, moonshots, like Michael said, they will be much harder to finance, right? So that's, for example, if we look at the companies we invested in earlier, and we were able to get follow-on funding, we have now very successful companies that we think kind of achieved the same than those companies that were doing the follow-on fundraise in 21. Now VCs look at it much differently, and they're rather questioning the risk side of it than the return potential of it.
Sorry to interrupt you guys, but basically, I don't know if it works. Those moonshot projects that you mentioned before, any options that you can provide us and examples of the moonshot projects and the projects that you consider as most like stable, or with maybe, you know, in those environments that can then have like more chances to fundraise or something? It's going to be cool to have some examples with real world companies, if it's possible, of course.
Think of flying taxis.
Of what again?
Flying taxis.
Yeah.
Like Volocopter in Germany. It's something that will take a lot of resources, a lot of R&D, and you do not know if it will take off technical reasons, for regulatory reasons, for practical reasons like physics and so on.
That's a good reason.
Yeah, the general question is how close to a market is it, right? I think, for example, if you're talking about a SaaS project, right, that is normally and also the barrier of testing something, right? Like testing a flying taxi is quite challenging, right? It's like you're not going in a garage and put something together and you try to make fly, right? But if you have a SaaS product that's providing a certain value for a certain customer group, that's an easy thing to test out, right? It's buying some Google campaigns, right? Assuming you have a good product, but it's not getting approval from some regulatory bodies and stuff like that. So I think that's how close to a potential, how easy it is for you and how fast and with how much money it is connected to actually getting first customer feedback, right? Finding the MVP, right?
Okay, cool. So basically it's like maybe not so much for the sci-fi projects at the moment, but mostly for those who are having some customers, trying to do something on the real market at the moment and getting something that they can show.
Yeah, as I said, I think we all know this risk-return curve, right? So I think we were sometimes very much up on the risk and return side, people placing these risky bets, and now it's moving slow down, right? So people are like, okay, maybe this business is not going to return 100x, but therefore the likelihood of it succeeding is more than 10%, right? So we're kind of moving down the curve a bit.
Okay, cool.
And
Thank you so much.
Also, the YC letter talks about default debt and default alive, which is a great analogy. So the Moonshot project is one that will be default alive in a very long time. And default alive, just for everybody, means that it makes enough money so it can sustain its costs. It doesn't make a lot of profits, but it makes enough to keep going.
Yeah, that's a good thing. Basically, in your opinion, those default alive projects now have more chances to fundraise and survive in those market conditions. So, okay, cool. So all of the founders should read a little bit about the default dead, default alive essay. But again, let's get back to the panel. Sebastian, you need to tell us something new.
That's a tough one. I think what has also changed. Does it work?
We're not sure.
Sorry.
What I should add, I think like the market is not that competitive, so it takes longer for founders to raise money. So there are not that many funds are taking longer to make a decision. So prepare for a longer fundraising period and reach out to many VCs. This is what.
How long is longer?
Few months at least, I think. This is what
few months longer than usual.
No, the process takes a few months.
Okay.
At least on our portfolio.
A question to all VC, and again, first of all, you, Sebastian, in your strategy, have you changed the numbers of amount of the startups that you want to fund within a year or no?
No, so we're right now we're raising a new fund, so we're not doing deals at the moment. But I think as we are gonna focus on the pre-seed, we still want to do 10 deals per year at least.
So it's going to be the same in the conditions that are going to be now. Yeah, okay, so it's a good news.
I think it's slightly different at the pre-seed and seed stage, and it's completely different on Series A+. At least what we see on the market, on our portfolio companies, or when I talk to a Series A funds. There are not that many Series A+ companies who are raising. If they don't have to raise, they're not doing it, or they're raising internal rounds.
Maybe letting me add to this number of deals. I think especially at pre-seed, and that's what we're seeing, that it's important that the fund does have capacity to support the companies, right? Because we're seeing this. We've been slower in our investment pace as we had originally planned for several reasons. But now this actually does pay off, because you really see in these times, especially if you have nearly all of our teams are first-time founders, right? They haven't been through this, and it really requires a lot of helping and supporting, right? It's And that's definitely eating, for example, in our case, it's eating more than half of our time, right? So it really is working with the companies, helping them to sort out the challenges, helping them to basically overcome financial gaps, right? Not just by money, right? But just like helping them to adjust their strategies. And I think this is really crucial. And the younger the companies, the less experienced the founders, the more I think as a VC you can help them and you can really bring value to that. So I think advice to founders is really also challenge how and if the VC can support you, but not just asking the VCs, because we're also selling ourselves. Right? You're selling us your company. We're selling us. We're selling you us as a funding source. But you can also talk to founders of that this VC has invested in and ask how supportive a fund can be, especially if you're in challenging times, right? So I think we're doing due diligence on your companies, right? Like we want to know everything, we want to see everything, and I think you as a founder, of course, you want money from us, right? But you have the same right of due diligencing us, and due diligencing us will be talk to the best due diligence is talk to founders the VCs have invested in and really ask were they supportive, how were they supportive, and I think that's maybe also an advice that helps you, and especially how can they help if shit hits the famous shit hits the fan, right?
That's a great point. Let's not forget as a founders that we also, it's a two ways game, I would say, and we also have something to say during that process. Okay, so we're running out of time for that question. Basically, if we can sum up, something within 1 or 2 sentences, if you want to add something, to that support, or like, have you changed your deal flow, lesser startups, more money? I don't know. You can add it now, or we can go to the next question. Okay, cool. Then the next question.
All right. So, all of you basically said about investing at pre-seed and seed stages. Now it works, isn't it? And from what we see in the market also, as you said, it's actually harder to raise rounds at the A, B, C levels, and companies are holding on to what they have or raising internally. But I'm assuming most people in the audience are actually at the pre-seed or seed level, so they will be very much interested in hearing what it means for you to invest in a startup at this stage. So can you tell us what early traction in a startup is considered for you acceptable, and what milestones a startup has to achieve before aiming for funding? So when's the time when a startup is ready to come to you, and what are clear signs for you that a startup is worth investing in? Pre-MVP, MVP, what does it take for a startup to start raising a round?
I think it depends, like about
Okay.
what.
Go ahead.
Like, there is no definition of a pre-seed, right? It's all about founders. You can we did a deal where there was 2 founders with a deck and nothing else, so it was just a concept. You can say that pre-seed can be a company with MVP or a working product with some usage of users, but without revenue. But there are companies who are raising pre-seed or seed with paying customers, right? So I think it all depends how bullish you are about the founders and what they have achieved before and what's the opportunity. And
for you as a fund?
For us, pre-seed is the first institutional round, meaning that if we really like the space and if we really like the founders, we can invest. If there are just 2 or 3 co-founders who are fully committed and have an idea and they know what to do and they have domain expertise and the market is big enough to build a 100 million ARR company.
I think adding to that is a concept I really like. It's no longer the concept of product market fit, but founder market fit, right? Because especially that early on, often if you talk a lot of companies, they're pivoting several times, right? But you have to have the right founders within the right domain with the domain expertise, right? That's one thing, and they have to be in a market that is growing and attractive, right? So we're looking more at the founders as their personality on the one hand and their expertise in the very domain they're in, and on the other hand, in the market they're in. How big is it? how much is it growing, and how's the competitive situation. So this is what we're looking at. So we're less looking at the actual product, right? Because knowing that very likely there might be pivoting along the way. So it's founder market fit is for us much more important than the actual product market fit.
Even pre-product, or you're still looking at whether the company actually has something to show?
No. It's pre-product is kind of hard, right? So it's there has to be at least a POC prototype or something like that. So we normally don't do anything before that. But once this is also knowing that this might not be the final product, right? But having a product prototype, whatever. Is also a sign for domain expertise of the founders if they were able to create something like that.
You can, and like when you know that this is like POC, so this is like, you know, that you can prove that concept is working and you are ready to invest or at least start talking to them. I mean, like in terms of the users or like, you know, some numbers, or at least some.
No numbers.
Some
no,
indicators.
I won't give you numbers, and even indicators are hard, right? So it can go. We have one company we invested in because of the. There were patents there, and there were people who are very experienced in the field, like world-class scientists in this field. So this is basically, it was really people with extraordinary expertise in that field that had patents around something which we thought has an implication in a big market, right? So that is like something very early for us, right? But we're also investing in companies that already have a product. Maybe it doesn't have the final features and everything, but that has already a product that they are where they have a proof of concept with an initial customer. Maybe it's even someone they kind of know. That's why they get the opportunity to do it. But I think we don't try to have that strict borders to say. It's in the end, especially if you're talking about very tech-driven innovation, some of these things even being hardware, I think it's hard to be too strict just saying it has to be that number, that achievement. So we try to be open, and I think even more open the more we look into opportunities, because we see the more we're trying to close ourselves off, even for example from hardware things, we're losing out on opportunities that we now investing for the last 3.5 years in this area that we would have missed out on if we would have been too strict. So I think we're always trying to take the first call, to get a first idea of what they're doing, then we try to basically define our criteria for every single opportunity there is. But yeah.
Cool. Yeah. Anybody else wants to add?
Yes, I can add something. So for us, we're a little bit later than Sunfish. So we really look not only at the founder, but also if there's product market fit. And product market fit for us is in a software as a service company that you have between 500 and 1,000 paying customers. So this is something that we really want to see at the moment, more than maybe like 12 months ago.
And that's a seed stage for you, right? Or
not necessary. It can be a seed stage or a Series A. That depends also on other factors.
Right. Thank you. Gabi?
Yeah, so I would say that every case is different, every team is different. So I am with Max that it couldn't be like generalized and put like specific number, to say like this traction is satisfactory for us. Of course, when we are speaking on some specific case about some specific industry, we have the competitive market. So we could see how other solutions in the space performing, how quickly they are attracting new users, how they are performing on some POCs, and pilots, how many pilots they have. It's for us, it's really really good to have this traction in place, and that we could check with the potential customers how the startup is performing, with the potential users, how the platform is performing. So we don't invest in like pure ideas only. We have to have some proofs that it could solve some significant problems, that it could be scalable business.
Okay, Konrad, you're totally pre-seed, so what do you say?
Yeah, definitely. So it's like for funds like ours, it's always team first. I think, as Max said, the product is going to change 100 times within the first 2 years. So with the change of the product, the market can also slightly change. All the market analysis that you may do at the very beginning may not be adequate 2 years ahead. Still, you have to do them. So it's always team first. The more experienced the team, the better it is. The more the team should always have some experience on the market that they're working in. Because, I mean, simply put, if somebody wants to do a startup on Formula One engines and they've never done anything regarding Formula One, I mean, their chances for success are pretty low. So they should have some market experience. If they have previous startup experience, that's even better. If they are serial founders, that's people that we can invest into without thinking about it twice, because they know the struggles, they know how it's. That the startup life is really difficult. They know how to deal with it. They know about fundraising, and so on. On that note, we also made a deal into a couple of students that were on their last year of university. The company is called Step Up. It's a Uber for cleaning homes. They're doing great so far. They have not had any business experience, but they're doing pretty fine. So it's team first.
Okay, but what makes you invest in a founder that has no experience whatsoever?
I wasn't around back then, but I think they were very convincing. In terms of their strategy, like I teach on a university, so it's when you have people pitching to you, it's pretty easy to see which ones are talking something sensible and which are just talking wishful thinking. And these guys were like super 100% operational and not focused on what they were trying to achieve. And you're pushing us very nicely for hard evidence, for hard numbers that we look for in startups. And that's where I can tell you a story of the dragon, SMOK. So apparently dragons, unicorns, these are $1 billion companies, and dragons are companies which are fund returners. So assuming that the fund invests in 25 companies, 24 fail, 1 survives, this one will be a fund returner, meaning that the exit from this company will equal to the amount of the fund. So you, at least, or more, of course, more, of course, the more the better. We're looking for dragons. So if we have the second fund will be is aimed at 50 million euros. In 8 to 10 years, we are looking at a 50 million euro exit value, meaning that we're looking at startups which in 8 to 10 years can reach a valuation of like 5 to 800 million or more.
So you're looking basically on the market of that product, so it can return you X 10, 20,
yeah, and it
100.
needs to scale super fast. If it reaches a 1 billion valuation in 25 years, it doesn't interest us. It needs to be 8 to 10 years.
Okay, and with the Step Up, for example, did they have any numbers or something some proof of concept? Okay.
Yeah, no, it was a proof of concept at the time of investment, but the potential is there. I mean, that they can reach this kind of valuation. For Fund 1, it was a smaller amount. So now we're looking on even more scalable projects.
Right, Maciej.
So we are pretty interesting in this sense because we invest from pre-seed to sometimes Series A, and even from the new fund we invested in one Series A. So we like to think about it in a way that the more techy the product, so the more meat in the company, the earlier we can take the bet and basically invest in something that, given the commercial traction fails and the product never reaches the market, there is something tangible to actually dispose. So it is all about trading the risk. So obviously we always want to, similar to like, I mean, that's basically true for every single venture capital firm. Like we want for every single company to return the fund. So in our case, it's, you know, at least $1 billion. You know, not every company will get there, but you know, we have to believe in one of the scenario. Like once every single star, like all of the stars align, then we have to see this path for this company to become a $1 billion company. But yeah, like for us to take a bigger risk without the product. So we've even invested in companies like, you know, similar to what Sebastian said, like 2 founders, a presentation, and no product. So from time to time, if we see that, you know, the team is amazing, great experience, and you know, like I can even give you the example. I can't disclose the company, but those 2 founders were, you know, great pedigree, great schools, 2 PhDs from Oxford and Cambridge. You know, one of them, CTO, spent 3 years at Google. He was, you know, in machine learning division at Google. The other founder was business development BDR at Palantir, and was selling like super complex products. And those 2 guys teamed up to basically bring, you know, an outstanding AI proposition for. Yeah, again, I cannot disclose too much, but we'll be announcing the round in January actually, so pretty soon. But you know, like those 2 guys were compelling enough, great experience, great background. One of the founders, you know, was researching the field for 2 years before he started the company, and you know, his supervisor on Oxford University is like one of those AI superstars that we also referenced the guy with. So, you know, he came recommended by one of the most successful business angels from London as well. So like everything kind of aligned. And in this particular case, we were comfortable taking the risk and investing in a company that, you know, they actually launched the product like 2 weeks ago or something. So just recently, and it took them like 6 months to get there. But in other cases, we usually want to have the product. We want to play with the product. We want to see traction. In many cases, sorry to break the news for you, no traction is better than mediocre traction. So you know, it's better to have 0 revenues than to grow like, you know, 2x year over year. For most of the investors, like that's true. So yeah, like, but we have to see strong traction, strong pipeline. A customer pool would be perfect. So, you know, we call it willingness to pay, right? So someone asking to pay for your product. That would be the perfect scenario, I would say.
Okay. One thing, sorry for interrupting, but it was addressed by 2 panelists before. I think it's much harder to qualify and quantify, but it's having the entrepreneurial feeling the entrepreneurial spirit in the entrepreneur, right? Sometimes you're sitting, like, of course, all the qualifications, all the network, everything, but sometimes you're sitting over dinner with founders and you see how much they're burning for what they're doing, right? They really want to do it. It's not like, oh yeah, I came from consulting and I want to do this because all my friends are doing startups, right? But you really feel that you feel this enormous energy, right? It's really something, and I'm happy that this COVID video call time is over, right? Because that's something that is sometimes very hard to feel over video, right? But we're really trying. If we are investing in a company, we really try to spend like a lot of time with them before, right? Like literally sometimes like an 8-hour workshop followed by a 4-hour dinner, right? Because then you really got to feel how they think, and I think that's hard to really, there's no way to measure it, and it's just you have to feel it, right?
And honestly, if you think about it, like, you know, making the decisions in 2021 based on like 4 calls or 5 calls and never meeting a founder, it's crazy. I mean, yeah.
We
completely agree.
We did it recently, it's 2022.
Sebastian mentioned that you expect founders to be fully committed, and that's a bit of a follow-on question and also a bit of a chicken-egg problem. If you don't have money, you have to make money somehow to support yourself, to support your startup. So, you know, as a super early stage founder, you have to somehow make your living, and you have to work probably a job to be able to support yourself. But then you go to a VC and you say, hey, I have a product, but I don't have enough money to actually, you know, maybe market it, maybe hire a developer, maybe do something more with it. And at the same time, I can't say I'm fully committed because I still have my full-time job that I have to support myself. What does it mean for a VC that a founder is fully committed? Are you expecting them to quit their daily jobs and say, okay, I'm 100% in and I'm not doing anything else because I believe in my product so much?
Yes.
Yes.
So you expect everybody to go broke before they come to you?
It's not getting broke.
It is a gray zone, and okay, it should be an interesting panel. We cannot only speak about the general truths. It's a very hard period for founders, and that's one of the reasons I don't want to become a founder. Really, I'm super happy with having a salary in VC because I don't have to worry, that what's going to happen next month. It's 100% truth. But if you're starting a company, you should know what you're doing, and you're signing up yourself for that. I guess people have savings that can last them for some time. That's one. Second thing, there are many non-VC type of financing places where you can get some funding for your startup, like grants, and other places which will allow you to start. You can sell maybe earlier if it's difficult for you to raise. Maybe you can think of even a simpler version of a product which you can sell to a customer and they're going to pay you. You can use that money in your company, right?
Like you can bootstrap, right? Before like not doing it full time, you can start with bootstrapping while having a full-time job, and when you're ready, you can go to a VC, say that you're fully committed and you're 100% focused on
basically that was a question. If you are working normally and you know that you still can deploy time for the startup and keeping up with the metrics and grow it, bootstrap it, then I think it's okay. I don't think that you one-sided that, or you should
but as soon as the VC hits comes with you have to drop everything else what you're doing, because they're investing all the time, all the money that they have into the company, so you should invest all your time.
Yeah, so basically before it's doesn't matter how you did it, but after you started
it does to a certain extent, I would say. I think what I've seen here, and this is a little bit different than what I've seen in German companies I've invested in. Sometimes you have these people, they work their day jobs, right, and they take all the money and their nighttime, and then they develop a product, right? So they really they work, make a lot of money invested in creating their product, and then you suddenly, when they hit the fundraising track and you talk to them, they already have 3 people financed from their own salaries, and they are working it in the night shift, right? This is really like bootstrapping at its best, right? And this is something I highly value, because you're not they're not coming to you with a business plan. It's give me the money and then I'll do that. So they really show you something. So I think compared to what we see sometimes in Germany, you get much more value for the money, because the people have already worked their asses off for a year and invested their personal savings for quite some time to already have something to show. So that's something we like. What we don't like is, and I think all of us have seen this before, you're talking to a founder, you tell them you don't like the idea, and then they're coming, but I have that other idea, right? It's literally, that's what you don't want to see. And one last thing, that's why we're skeptical in financing or funding spin-offs or spin-outs, not from universities, but I think we often see spin-offs from software houses. So in the end, this ends up, the software house still holds 80% of the equity, right? Which I would consider largely debt equity in this context. And then they have 2 managers, they all have 10%, right? And they're supposed to basically make a product company out of something they have developed as a software house, right? I'm not saying that there's no cases where it works, but I would say 95% of the cases it doesn't make sense, right? Because again, you don't have that committed founder on it, and you have a lot of debt equity in there.
Okay, cool. That was specific case, I would say.
And
But
so
if we can,
just to make one thing perfectly clear, as soon as there is money in the startup, a founder should be receiving a salary. It's super important for people to remember that. Usually, it's not going to be a market salary. It may be slightly below the market salary because you want to hire as many people and grow the company as much as you can. However, as soon as the startup becomes profitable, it goes to around B, C, or even above. It could be as big as the salary could be as big as it gets. But at the beginning, some struggling has to be expected. But the salary has to be there because people have to make a living, which also contributes to their mental health and their ability to work for the startup.
Okay, so this is post VC, and please guys correct me if I'm wrong. Before that, you appreciate a little sacrifice for the project, and it could be your time and kind of those things that you can do within that time, but you are sacrificing that time and working on your product, or either it could be some finances and some other alternative costs.
Yeah, so basically hearing a pitch that, hey, I have my full-time job, but I have this amazing idea that wouldn't work and that wouldn't fly. But there are different hacks and shortcuts that you could take. You can go to the accelerator or an incubator Startup Wise Guys or Y Combinator or a few of those initiatives out there. Entrepreneur First, for example, if you're a technical or business co-founder and want to find your business or technical counterpart, you can go to Entrepreneur First, get 150k or 200k euro investment. It comes at a 7% dilution, I believe. And then having 200k in your bank account, you can basically start working, right? It's not even a sacrifice back then. You have 1 million zlotys in your bank account. I guess it's enough to bootstrap. I mean, again, it's not bootstrapping anymore, right? But to kind of sustain a team of 4 or 5, right? So I think there are very different and various paths how to get there and actually start a company. But
okay,
it's
great.
Yeah.
But it's great that you mentioned the red flags, because basically this is our next question, but we don't have much time, so just a few sentences about the red flags. So basically, what are the obvious red flags that you are seeing in the founders that they don't understand, but also that can be easily avoided by founders? And do you have a story basically of some of those red flags that made you stop talking to a startup or not start talking at all at the very beginning?
My favorite right now is basically following the hypes. So in the past weeks, I've been talking to a bunch of founders who are building generative AI products right now. And last year they were all about Web3, and 3 years ago they were all about marketplaces and basically and health tech, whatever. Your story has to be consistent somehow. You have to be passionate about something, and obviously you can jump between industries and build different products, get inspired, and find a co-founder that would kind of change your trajectory. But I believe it is super clear and obvious when you're basically jumping hype trains and you're building products because it's hot and it's relatively easy to raise money on this product. So I would say the number of founders.
Yeah. Not to follow hype every week, because basically now we have an AI. Probably a few months ago we had Web3. A few months ago we had something else. Cool, Konrad.
Sebastian, you want to go in? Go ahead. No, the list is long actually of red flags, so I think we'll get there. Well, then I will say a messed up cap table. Cap table is the ownership of the company, who owns how much. The more the founders own at the very beginning, the better it is. And it's a situation that, I don't know, there's a guy who had the idea, and he has 30% of the company, and now operationally doesn't work for the company. But since he had the idea, then he has 30%. It won't work, not a chance. He can have 1% or 3%. not 30.
This is
so
probably
that's an
some
example.
uncomfortable topics for the startups, so I think they should know that you can talk it out with the co-founders or ex-co-founders about that.
Yeah. The good news here is that you can fix it, and I've seen startups fix their cap tables as long as people on there are willing to talk and understand what's the issue. Then you can fix that. That's also a very common issue in spin-offs, which Max mentioned earlier. When you have a spin-off from anywhere, a university, a software house, or another company, the cap table is usually messed up. And in these cases, it's much harder to fix it.
Okay, thank you.
It's hard to like raise when the cap table is fucked, but still you can fix it at some point.
Can we just maybe explain for, I don't know if everybody knows like what a fucked up cap table means. It probably means that the founders have less than 50% of the company, right?
Not necessarily.
This is what Max said before, like if you're having like a spin-off where there is like a software house which owns 80% of a company and two managers who are running it has just 20%.
Basically, we're talking about someone that are kind of a dead weight for the startups, or they are not doing anything, not like, helping startups, gain something, and just have part of the company which could be big.
Yeah, like in general, like to raise a Series A, probably founders should have 50% plus equity, right? And if you go down to the pre-seed, then you need at least like 70% or 80 or 90.
The easy rule of thumb is, I think it's also changing nowadays with the valuations, what we talked about before. But I think the math is for each round you'll give up anywhere between 15 and 25%, right? It's these values can shift. They can go as much down as 10, but I think they shouldn't go. I think 25 is really like the maximum, and then that's the dilution. So you do the math. Then you find out how much dilution you can take. I think losing majority for founders after A, I would say after A they should still have more than 50%. That's my belief. Most likely at a B round. So. They will eventually, or they might eventually lose the majority, the founders as a group. But I think that's the math to do. So if you're looking, I think it's getting better in the market. I think when we all came to the market, there were literally like companies where the business angel had 49%. Right, like literally someone. Of course, they helped to kickstart the company, but this is killing it for us as VCs. Right, we cannot invest in this company because we know when we get in, and then we all know there's one or two more rounds coming. The founders will be diluted so much, so that simply, kills the economics of the deal.
Okay. Any other red flags here? Because basically, you tell us the list is long, so we can continue.
So I would say that unclear value proposition. So when we put some time to go for a meeting with the founder, and at the end of the meeting we don't know what they're actually doing. Yeah. So that situation happens sometimes. So there is a lot of buzzwords as well, but what it's like really red flag for me, it's also a kind of statement. We have no competition on the market. We have the best product of the market, and it really happens that we have such company, we have meetings with such company. And the thing is that you as a founder have to be aware of the fact that, okay, we are investors, we are sitting on this different side of the table, but every day we see a lot of different solutions, a lot of different pitch deck. We have discussion with many, many companies, and it's just like really crazy when sometimes we are telling you who your competitions are. So I think that here, making really good research and be expert in the market where you are operating, be prepared for the meetings. It's super crucial. And of course, being honest. So knowing the competition and don't telling the investor the competition also, it's really, really bad signs. So I would avoid that.
Michael.
can only say maybe something from a different perspective. We don't have a long list with red flags where we check each point of the list when we have a startup to go through. It's just something that comes up during our normal process of evaluating the founder and the company. So there is no thing that you can say, oh, I have this checkbox, this checkbox, this checkbox, and now this business is investable. There are some clear facts, I think, like the cap table and so on. We just heard that is clear, but it's not like you go into a due diligence or whatever and look for certain red flags. You look at the business, you look at the founder, you look at the team. You look at the market, you look at the unit economics, at least from a certain stage, and during that you want to get convinced. And if you have a founder that is really burning, and I always have to remember Stefan Batory, who founded Booksy. It was very clear after the first meeting that he's fully committed. It is really burning, and there was not the question to look if he's having some other job before. And I think there is also some qualities that founders may have, but there's always founders, for example, who had never founded a company before. Many investors, they look for people who have already done a fairly successful startup, founding for the second time, or coming out of a successful startup or venture. But there are people coming from university, and if they're fully committed, if they're in the domain, then they can be very successful founders. So there is no real checklist.
All right, thank you.
There's maybe one sentence when I'm that's a big warning sign, or I think it's sometimes you listen to what the founders tell you, but I think one thing is when the founder comes to you and tells you, oh, but that's what I earned in my previous job, right? Then you know he's still in the employee mindset, right? So that's a big warning sign. And last thing, I think different expectations about the potential of the company, right? So this is true for your co-investors, but also what the founders. What does the founder want to build, right? Does he want to build a company that he can eventually sell in 3 years for 3 times the price, twice the price that you're paying now? Or is he really in for building something big? And that has to be in line. And that's true for the founder, but also your co-investors, right? Because if these things go, if you don't agree on these things, you'll have a lot of discussions going forward.
All right. We've exceeded our time for this panel discussion. Sorry about that. I hope it's been interesting, but it's time to move on to some questions from you guys. So I'm gonna kick it off with something that's more or less a yes/no question, so should go quickly. First of all, do you invest in companies incorporated outside of Europe, like in the US? But led by EU founders. So that's one question. And the other one, do you have any solo founders in your portfolio? So do you invest in companies outside of Europe? And do you have any
yes and yes.
Yes and yes. Innovation Nest is yes.
It can be made possible. So if you have public money, there are some tweaks you have to do to make this possible. And solo founders, we did in a Krakow company, and I think turned out not to be a good decision.
Oh.
I wouldn't rule out the solo founder, but we would not invest in companies that are non-European.
So we invest outside Europe, but no in the solo founders.
The company, the registered company, could be registered on the moon. I don't care. But the team has to be in Central Eastern Europe. That's the promise that we gave to our investors. And for the second question, no. I personally do not believe in solo founders. I think it's such a difficult job that you need support. A team that will support you, not employees that will do a job for you.
I have to add. My answer to question one is the same than here, right? So there is where the entity is. It's there's a lot of flexibility and ways to work around. But as we are also committed to CE and Poland, so just investing in any company doesn't make sense. But R&D in Poland, but company as an Inc or whatever, that can be made possible.
We don't actually have any public money in our fund, so it is 100% private. So we don't care where the company is headquartered, but we like our roots and our DNA is basically investing in founders from the region. So we invested in a bunch of companies where, you know, like 2 Slovaks or 2 Poles or 2 Czechs started their companies in the US, and you know the entire team is based there. Everyone's there. There are no other you know roots to the region and connection to the region, other than you know that they knew us or we knew them, or you know someone introduced us to those guys. And the second question, yes, we have solo founders in our portfolio, and we don't.
Okay, that's great. That's different point of view. So here we have another question from the anonymous, and this is: what is the biggest regret, specifically not funding someone, if any, and how did you personally deal with your regret? And we are all interested in regrets of not funding some companies. If you can share it, please. Who will be brave enough to start?
So I think everybody has some companies he wish he would have invested. I think there's no way to do it if you are in this game for a couple of years. And of course you will remember it, but you cannot do every deal. That's simply not possible. And you need to be really convicted with any deal. So if you're not fully convicted, and normally you share it within your investment committee, and all the others, they also must go with the deal. So there will always be deals who fall through, even if you are convinced. So it's you simply do not have to think about it. It's just what happens.
No regrets here.
A few years ago, I worked here, just on the other side of the wall in Hubraum. I was an investment manager, so basically doing the same thing as now, but for a corporate VC. We had a company in our program called Toolsense. It's an Austrian company, and at the time I did not believe what they were doing made sense. They were doing IoT for hammers and drills, like heavy industrial equipment. And I think last week they closed an 8 million Series A. It's not big because it's only been 3 years, but you know, so it's not like a billion investment.
Maybe it's a future regret.
But it's big enough.
I think what's most important for me, if I see something becoming important that was in my investment area, if I had the opportunity to look at it, that's the only metric that counts for me. So if I missed it because I didn't have the opportunity, because I didn't see it, right? That's a problem. That's the big warning sign. And then we're really checking internally if such a deal happens, is why did we miss out on the deal? Having missed out on the deal because deliberately deciding, looking at it, it's nothing for us, having tried to get in, but just other people were actually doing the deal. That's all good, but not having seen the deal, that's what I would regret, and that's when I internally in the fund would try to find out why did we miss the deal.
100% agreed. VCs have a very strong FOMO.
And I think it is like we keep talking about it at Credo all the time, that it is important to disconnect the decision from the outcome, and without having this clarity of thought, and you know. That is why we take a lot of notes about every single deal, and we are pretty diligent about it. And we're like, you know, all like coming back to our decision-making process, and you know, we obviously have huge misses. Even today, Muse, a hospitality company from Prague, announced 200 million round at I believe, north than $1 billion valuation, and we passed on them like 3 times.
Oh my God!
So it's, yeah, but that's the.
But
business,
basically,
right?
you don't regret like gambling on the idea. You are mostly regretting if you didn't spot the project at all.
But we actually had a very long discussion about like why we passed, what was the rationale, and back then, looking back, it all made sense. I mean, we had a different perspective. We didn't believe in the space, and
But you sleep at night.
Yeah, absolutely.
Oh, okay,
it was
that's
not
cool.
me. So,
So we can close the personal
It's
side.
important to have a reason why you passed. If you've seen something and you've discussed it internally with the IC or with your colleagues, and if there is a good reason why you've passed, then you sleep at night, right?
Okay, cool. So another question from Piotr, and here is: what's the craziest idea you have invested in that worked better than you expected? No crazy ideas?
No flying taxis.
No sci-fi.
The judgment is still out with most of the crazy things we invested, right? So we'll get back in 5 years and then we'll tell you.
Okay.
Do you maybe have some questions straight from the audience live that you just came up with right now? Anybody's brave enough to ask?
Being brave or not, but I just want to understand. All right, thank you. All right, guys. I mean, okay, so we talked a lot about the red flags, what we don't want to see in startups, what we don't want, what we are missing on, and etc. But what do you seriously hope to actually see in a startup? Like, what do you seriously feel like? Jesus, if I can have that, I would just go for it. Something that we could all agree on, but also could meet different criteria, right, of multiple startups. Because I know it could be really, really picky to choose a startup, but what could be the common criteria that you feel like, if I could find this, if I could find a startup that would do that, I would definitely gonna give it a go. That's it. Thank you.
That was a good question.
As a strong repeat founder with a deep industry insight, who has been there, done that, who knows how to hire people, and has a strong network of executives, of people who this founder could bring on board, who'd be working on a huge idea that could actually become $1 billion company. And exactly the same founder should have very clear answers. What are the hypotheses he wants to test with this money? So I don't want to hear, that my company is gonna be huge. Like, no one knows. And the founder doesn't know, we don't know. Everyone's taking risk, right? But what I'm looking for is like having a very clear answer as to what has to be tested in order to make it work. And if the founder knows what he doesn't know, and that's probably the best outcome. Like, I don't like to work with people who don't know what they don't know. That is kind of, yeah. Because I'm a generalist investor. I don't know what you don't know. So you should know what you don't know. So yeah.
Konrad, few words.
Then I mean, nothing substantial to add. I completely agree with what Maciej said. No reason to, prolong and keep you sitting here much longer.
I will prolong. I'll let you sit here, but I'll try to make it short. I think what we want to see, coming back to what I said before, people are really burning for what they're doing. Right? You're looking in the eyes and you see them burning. Right? Like this is what we want to see, and investing in something that does have an impact, and I'm not just talking about a general like environmental impact, whatever there is, but something that really has an impact, that really kind of changes people's lives somehow, right? I think that is something that always, apart from the economic outcome that hopefully is there, is great to see, right? Like not necessarily. Yeah, I will plug one of our companies, right? Ether Biomedical, that they develop prosthesis, right? And you really see people who are using this and whose life is improved by this product, right? It's like having an impact. Why did we invest? Because it's a great team and we want to make money with it, but also having the nice side effect of this impacting people's life. And this is sometimes a bit harder with SaaS products. Also, they are very useful and profitable, but they're not often not impacting people's life that much.
I would add to that on top of what Maciej said, of course, it is this passion which we could feel starting from the first meeting, and also understanding the story behind the product. So sometimes we could say, okay, it's a great product, but like, where is this story? Where everything it goes? I would say that this passion which founders could make us amazed, and like make us a fan of what he or she is doing. It's also a superpower.
Okay, cool. I think we can sum it up with like founders in place, market in place, and burning eyes, and just few things.
But not rubbish.
And also I would say that an investor also needs to like the product and be passionate about the product. Like, sometimes, I can see a great business in a company, but I just don't care about the business, about the product, and about the market, and about the problem it solves. Like, I couldn't be more, I couldn't care less about what the company is doing. And I think, the relationship between the founder and the investor, in best case scenario is great, but that's not true in many cases. Like, there are ups and downs, there are stressful situations, and it's kind of you have to be fully committed, not only in the like founder investor relationship, but also in like the product and the market. And sometimes it's
okay. So everything that I mentioned before, plus investors should have fun.
Yeah.
Okay.
This founder-investor.
Why not?
Yeah.
This founder-investor relationship is also important. Like if there is a match from the beginning.
Okay, so we have only one question left, and we also have here Andra. She is a creative strategist in small 5 people team coded Celestify, and asking, can we contact later for the feedback? Yes, there will be a networking right after the next question. So basically, the last question will be, how do you support invested companies? Like, from whom would you describe your investment as smart money? So basically, what you're like, if you're given smart money, what's like smart beside money? I don't have money. I cannot describe it.
So I could start here. Here we are like only a CVC fund in this round. So I would say that for sure the access to the corporation. We are trying to build a bridge between the startup world and between the corporate world. So we have many experts from like various industries. We have also access to the technology, which could be tested within the startups. As at the beginning, Jerzy said, we could also give access to really new technologies. So I think that it's something what makes us special. On top of that, of like business and tech expertise, we could also open the doors to the Deutsche Telekom customer channels. So bring the product to the sales. And I think that it's something what we could make, what makes us special. Of course, it takes time, because when we are speaking about early stage startup, we couldn't make it the day after that we implement the product into our offering, but it happens.
I think it's a lot about like answering the questions of a founder. Like as a VC, we are not there to show you how you should do your business, but to be just supportive. Just to be supportive. So if you have a question, either I should know the answer, or as a VC, it's really cool that you basically can reach out to everyone, and there is a quite big chance that someone will reply, or you know someone in your network who knows the answer to your question. So it's being supportive in answering your questions, or knowing someone who can give you the answer.
Also, being a sparings partner to the founder, right? It's not only always about business related questions. This is I think important. Just helping them with ideally your know-how and your network, right? Because they will most likely, hopefully, they'll know more in their industry than you do. But you can sometimes just help them with organization building or some basic challenges they're facing that are independent of the actual industry and product they're in.
Yeah, I think the last part is absolutely true. So like something like hiring and other functions like finance, controlling, how you build the reporting and so on, how you set up different bank accounts with your systems and so on. So a lot of day-to-day business-related questions. And of course, there are also from time to time people who don't get along. They found a company together, but after like 1 year, 1.5 years, 2 years, maybe there is some divisions and so on. So we can help also with that. And I think that makes a good VC or a good investor, that they don't know more about your specific domain. You have to be the expert there, but there are a lot of functions and processes that you need when you build a company. And this is something that shifts when the company grows. So a 10 people company needs another set of processes and management than 25, 50, 100 people company. And normally the founders, they have not seen each of those stages, so we can help them, speaking for all of us, during all of these stages, and refer people, sometimes interim people or experts for certain domains that have been in startups at the exact stages. For example, if you are at 10 million ARR, you will need someone running finance, and we know people who have done it, so we can refer it, you can talk to them. I think that's also a lot of value.
Cool, perfect.
And a good VC constantly challenges you, right? I think not to annoy you, but I think that's constantly challenges what you're doing. So to make sure that you're not just operating in some void, right? So I think a VC challenging you is not to be a pain in your butt, but it's really like to make you think about decisions and strategies over and over again.
I think it's very important to have this conversation with every VC that the startup is talking to, because to get expectations clear. Because you will have VCs which are investing in pre-seed or seed or any stage, which are very hands-on, and you will have VCs which are very hands-off, which will stay out of the way for many different reasons. So it's important to have this conversation. Generally, most touch points between a VC and founders are just before and during the fundraising process, and that's because VCs participate in fundraising all the time. Founders do it a few times in their lifetime. So typically VC advised most in that process, like how to get the pitch deck, how to talk to which VCs to talk to. Obviously, they make intros to relevant VCs.
Maciej?
Maciej fell asleep.
Lost.
Just great to listen to you guys. So we think about it in three ways. when it comes to the day-to-day guidance that we provide, we don't oversell. And like I, for example, during the fundraising process, when I'm doing my best to win the deal and investment, I'm saying that, hey, I've never been an entrepreneur myself. I'm kind of a born and bred investor. I've been investing for 7 years now. And, let's start a WhatsApp group and let's chat and let's see where it gets. And, I have some network. I know other investors and, maybe I would be able to help you, but I never oversell here. Then we have a hiring function. So we have a talent partner who, actually 2 people on our team, on our payroll, who are supporting our portfolio companies in hiring. So that is useful and founders actually appreciate that. And the third thing is, as Konrad said, basically the investor network and fundraising support. And in this sense, we are pretty interesting here because we have 2 people on our team, Andrei, who spent 4 years at in Silicon Valley, so he knows pretty much everyone on the East Coast. On the West Coast, we have Karolina, who spent 10 years in New York, so she knows everyone on the East Coast. I know a lot of investors in Western Europe because that's what I was doing in my previous firm at Innovation Nest. So investing mainly across London, Berlin, Paris, Amsterdam, and Western Europe in general. And then we are pretty well connected in the CE as well. So that means that our network across basically US and Europe is pretty broad. And the likelihood that we don't know your dream Series A investor is pretty low. We most likely know those people who would invest in you on Series A. So that is basically,
Network, yes.
kind of.
Well, without a network, there's nothing. I mean, you can't build a startup without a network, and having a VC that has a network, that helps a lot. All right, guys. As you can probably hear, the networking has started already over there, but you probably are most eager to talk to those guys and girl. Can we switch to the slide with our VCs? If we can, that would be great. So you would remember who's who. We have Maciej from Credo Ventures, we have Konrad from SMOK VC, we have Gabi from Hubraum, we have Michael from Müller Medien. I'm probably saying this wrong again. We have Max from...
But Marcus is also here, so the
Marcus
gentleman on this picture is somewhere here as well, so
yes,
you can
photos.
reach out
That's
to both of us.
Always. And then we have obviously Sebastian at the very end. Sorry for this position.
Doors are closed.
From Innovation Nest, but as he said, they're not investing right now. But it's good to get to know them already now because the fundraising process is long. So before you get there, they're probably gonna have the money. So big applause once again for our panelists.